Hello and welcome back to your daily English dose. We are diving deep today into a topic that, well, it's making headlines pretty much everywhere. Gold.
That's right. Gold prices have been absolutely rocketing lately, really hitting historic highs. If you look at Japan, for instance, the domestic price per gram, it's gone over 20,000 yen. That's basically doubled in just the last couple of years. It's a huge move, really, in a very short time.
Wow, doubled. That is an immense surge.
Yeah.
So our mission today really is to unpack this. What's driving it all? Is this just, a quick market bubble, something temporary that's going to burst, or does this price surge maybe show something deeper, like a fundamental distrust in the usual safe places for money, like, say, certain currencies or government bonds?
Yeah, exactly. We need to look at, well, what's pushing this price? So we'll explore the immediate kind of short-term causes, things like recent global events. But then, and this is important, we'll move to the big long-term structural reasons, especially looking at who the really big buyers are. And finally, we'll touch on the sort of unchanging scientific reasons why gold just holds its value, across millennia.
Okay, right. Let's unpack those short-term factors first then.
Yeah.
If we look at just the last few months, maybe the last year, what caused these immediate, pretty dramatic price jumps?
Well, the first and probably the most obvious factor is what we call geopolitical risk. It's often called the flight to safety. Basically, when uncertainty ramps up globally, maybe because of war or conflict or just high international tension, big money needs to find a secure place and fast. So funds tend to move into something that's, well, stateless and also highly liquid, like a physical asset. Gold fits that perfectly.
Okay, stateless. What exactly do you mean by stateless here? How does that work?
Stateless basically means it doesn't belong to any one country or government. Think about it. A bond is a promise from a specific government. A currency is managed by a specific central bank. Gold, though, it's just metal, physical metal. Its value doesn't depend on the stability of, say, the U.S. government or Japan's government or any particular bank. So if there's a major crisis, people trust the gold itself, not necessarily the promise attached to a piece of paper. And this big shift of funds into gold, well, that makes prices spike very quickly.
Right, that makes immediate sense. When things feel unstable, you want something outside the whole political system. But there's also a big currency factor affecting prices, isn't there? Especially if we look at that yen price in Japan you mentioned.
Absolutely.
Yeah.
Yeah, this is really crucial for understanding the price in places like Japan. See, gold is traded internationally, mostly using the US dollar. So imagine you want to buy something, maybe a luxury item, priced at 2,000 US dollars. If your local currency, let's say the yen, gets weaker, it depreciates against the US dollar, well, suddenly it takes a lot more yen to buy that same $2,000 item.
Okay. So if the yen weakens, the price of gold in yen automatically goes up, even if the dollar price of gold hasn't budged at all.
Exactly right. And this yen weakness, it's been pretty significant, mainly because of the big gap in interest rates between the U.S. and Japan. So if you're an investor in Japan, buying gold isn't just a hedge against global instability. It's also become kind of a necessary hedge against the weakness in your own local currency.
So it sounds like gold is sort of fighting a defensive battle on two fronts then. Global uncertainty and local currency risk. Now, are the experts saying this big price spike is just a temporary reaction, to current events, or is this something more permanent, a real shift in value?
Well, the general consensus among major financial analysts seems to be that this isn't temporary. They think gold has moved into a new kind of regime, what they're calling higher for longer. It suggests a structural shift, not just a short-term blip. If you look back at the price history, the old sort of structural price floor, the minimum price most experts kind of expected was around 2,000 US dollars per ounce.
Okay, and what are they thinking now? What's the new floor?
Now, we're seeing a new consensus building around a structural floor of about $3,000 per ounce. This suggests that the market really believes the risks we just talked about, geopolitical tension, monetary policy worries, they're not going away anytime soon. This new higher floor, it signals some deep, long-term changes in how big institutions view safety.
Right, and this is where it gets really interesting for me. Because if that floor has shifted structurally, that must mean there's some huge consistent buying going on. It can't just be, nervous individuals like you and me running to buy a bit of gold. It sounds much, much bigger than that.
Yeah.
What are central banks doing? The big players worldwide.
Yes. This is probably the single most important structural trend happening right now. Central banks, these are the institutions that manage national currencies, remember. They have been net buyers of gold for an incredible 16 consecutive years. That goes back all the way to the 2008 global financial crisis. They're just continuously absorbing massive amounts of gold supply year after year.
16 years. Wow. That really suggests they're not just speculating, are they? They must be making some kind of fundamental decision about, I don't know, the future of global money. What's their main motivation here?
It's definitely strategic and it's very long term. They're not trying to, make a quick buck by selling in 6 months. Their main goals are things like preserving value over the long haul, hedging against inflation risk, and diversifying their foreign reserves. They want to rely less on any single currency, like, for instance, the US dollar, and they tend to buy strategically, often sort of regardless of the short term price swings. And this consistent, huge demand is what really helps create that high, stable price floor we were just talking about.
Okay, but if the central banks themselves, the ones who are supposed to be the ultimate stabilizers of the whole global financial system, if they're buying gold nonstop, what does that tell us about the foundation of the system itself? I mean, does this mean that global stability we kind of take for granted is maybe weaker than we think?
That's exactly the deep dive insight right there. It implies a pretty significant decline in trust in what finance people sometimes call soft collateral.
Soft collateral. Can you break that down a bit for our listeners? What is that?
Sure. So back when the global money system moved away from being directly linked to gold back in 1971,
Yeah.
it started relying more on, well, soft collateral. These are things like promises of stable monetary policy from governments, international agreements, global cooperation, the rule of law. These things are absolutely crucial, of course, but they aren't physical guarantees like gold is. So by buying physical gold, central banks are essentially hedging. They're hedging against the possibility that this soft collateral fails. They're hedging against the risks built into the very fiat currency system, the paper money system that they themselves manage. It's actually a fascinating contradiction, isn't it? They're buying insurance against their own potential policy risks.
That really positions gold as the ultimate sort of backstop, the ultimate risk hedge in the modern financial world. Not just for individuals, but wow, for entire nations. And we should probably mention briefly that this demand isn't only coming from governments, right?
That's correct. Yeah, we are still seeing pretty strong consumer demand as well. This is often driven by things like economic growth and rising wealth, especially in regions like Asia Pacific. Consumer buying, particularly for things like jewelry and small investments in places like China and India, that's recovering quite strongly. So this adds another layer of consistent long-term demand that helps keep that price floor high.
Okay, so gold is clearly a great financial asset right now because of, well, geopolitical risk and massive institutional buying. But let's step back even further. Why this metal? Why has gold specifically held value for, like, literally thousands of years across every culture when countless currencies have just disappeared? Let's talk about the science behind it.
Right. This is where we get into what you might call its scientific immortality. The chemical reason gold is so trusted is simply its durability. Gold is what chemists call an inert metal. What that means is it's highly stable. It barely reacts with other elements like oxygen or water under normal conditions.
And what does that mean in simple terms for everyday understanding?
It means it does not rust. It does not tarnish. It does not corrode, not like silver or copper or iron do. If you were to find a gold coin made, say, 1,000 years ago, it would still shine pretty much the same way it did when it was first minted. This incredible stability is the fundamental scientific reason for its long-lasting, unchanging appeal and value.
And we know this quality, this unchanging nature. It was recognized way back by the very first civilizations.
Oh, absolutely. Think about ancient Egypt, going back maybe 4,000 BC. They saw this incorruptible nature of gold and immediately connected it with immortality, with the power of the sun god Ra. That's why pharaohs were buried with just massive quantities of gold, the famous golden masks, golden coffins, all that. Its unchanging nature gave it this universal, almost sacred kind of trust that went beyond any temporary political power or cultural belief.
Okay, stability is one thing. Now let's talk about its absolute scarcity. You can print unlimited amounts of paper money, but you just can't manufacture gold, can you?
No, you absolutely cannot. And this physical limit is the second really unshakable driver of its value. Think about this statistic. Only about 183,000 tons of gold have ever been mined globally in all of human history. Now, to try and visualize that entire amount would only fill about 4 standard 50-meter Olympic swimming pools.
Wow. Just 4 swimming pools for all the gold humanity has ever found. That really, really puts the scarcity into perspective.
It does, and the situation is actually getting tighter. Geologists estimate only about 50,000 tons remain in the ground that are, economically worth extracting with current technology. Now, if we keep mining at the current rate, which is about 3,000 tons a year, those known reserves could theoretically be depleted in only about 15 years.
15 years. Seriously. That sounds like a surprisingly short timeline. What happens if we actually hit that physical limit?
Well, that physical limit pretty much guarantees its value will continue to climb structurally over the long term. Once easily mineable reserves diminish, the supply of new gold will depend almost entirely on recycling what's already out there. That makes newly available gold extremely rare, far rarer than it is even today. This physical constraint ensures that its value can never really drop to zero, unlike, say, a currency that a government could theoretically print into worthlessness.
And besides its money value and its use in jewelry, gold also has important practical uses too, doesn't it?
Oh, definitely. Gold has some superb industrial properties. It's incredibly ductile and malleable. That means you can shape it easily. Just 1 gram of gold can be stretched into a wire about 3,000 meters long. It's amazing. But more importantly, because it doesn't corrode and it conducts electricity so well, it's actually essential in modern high-tech electronics. Semiconductors, computer chips, pretty much every cell phone and computer has a tiny amount of gold in it because of these properties.
So it's this magic combination then. Chemical stability plus absolute physical scarcity. And that equals, well, eternal value, seemingly. Let's quickly trace its role as actual official money. How did this stable, rare metal become the global financial standard for so long?
Well, gold was known and valued way back, maybe 6,000 BC, but the really key moment for standardizing it as money came in the Lydian kingdom. That's in modern-day Turkey. This was around the 7th century BC. They issued what's considered the world's first standardized coin, the electrum coin. It was a natural mix of gold and silver, but crucially, it had a fixed weight and an official value stamped on it. This made trade much, much easier and more reliable.
Right, so that standardizing step, giving it a fixed weight and value, that created the foundation for the gold standard we hear about in the modern world.
Precisely. Starting mainly with the UK back in 1816, the gold standard system was properly established. What it meant, basically, was that central banks held physical gold in their vaults, and they printed paper money that was guaranteed to be exchangeable or redeemable for a fixed amount of that gold. So if you walked into a bank with, say, a $5 note, you could demand a specific, fixed amount of physical gold for it.
That system sounds inherently stable, doesn't it? Because the amount of currency floating around was directly restricted by the amount of physical gold the government actually held.
It did create a lot of stability, yes, and it fixed international exchange rates, which helped trade. But the system started to run into trouble when governments needed to spend more money than their gold reserves allowed, especially to finance things like big wars, think World War I.
Okay, which eventually led us to the system after World War II, Bretton Woods.
Yes, the Bretton Woods system. That was slightly different. It was really the gold dollar standard. Under that system, the US dollar was fixed to gold at a rate of $35 per ounce. And then all other major currencies were fixed to the US dollar. So the dollar became the world's main reserve currency. But there was a fundamental problem, a contradiction built into it. You had a limited supply of physical gold, supposedly anchoring an ever-growing, theoretically unlimited supply of US dollars being created. Especially as U.S. debt grew rapidly due to things like the Vietnam War and expanding social programs back home.
Right, that contradiction, it couldn't last forever.
Exactly, it couldn't. And it led directly to the moment that really changed global finance forever.
Yeah.
The Nixon shock in August 1971, President Nixon went on TV and announced the U.S. would completely stop converting U.S. dollars into gold for foreign governments. And just like that, it ended the gold standard entirely. From that day forward, the value of currencies around the world depended entirely on the policies of governments and their central banks, not on any physical anchor like gold.
So, bringing it all together, what does this history and science mean for us today? In this world where currency is backed only by, well, the promise of the government.
Well, gold is no longer the official anchor of the system, clearly, but it's taken on this incredibly critical role as, you could call it, the final insurance or the ultimate hedge. It basically protects investors and even nations against 3 main things: policy risk, meaning bad government decisions; geopolitical risk, war; instability; and perhaps most importantly, declining confidence in fiat currency itself, that's paper money, backed only by trust. And that massive ongoing central bank buying we talked about, it really demonstrates that this hedge function is now considered almost an essential piece of national financial security by many countries.
And given all these structural drivers, the geopolitical uncertainty, the currency instability, this deep institutional distrust maybe,
Yeah.
the long-term outlook for gold must be looking incredibly strong.
It certainly looks that way. Most analysts are pretty confident that these underlying trends are firmly in place. And some of the long-term predictions are, well, quite bold. For instance, looking out towards, say, 2045, given the current structural supply issues and the expected demand, some analysts think prices could potentially reach something like 50,000 yen per gram in Japan. Now, that's a long way off, but it shows people are increasingly treating gold not as some temporary trade, but as an essential long-term protective asset against really deep systemic risks.
So just to summarize this whole deep dive then, the dual strength of gold seems pretty undeniable. One, its basic value is guaranteed by chemistry and physics. It's eternally stable, it doesn't corrode, and it's absolutely scarce. And two, its financial role today is as this kind of universal stateless currency that acts as both a signal of and protection against global and monetary instability.
Exactly. And maybe here's a final thought for you, our listeners, to consider. Gold has essentially never lost its core value since maybe 6000 BC. It served as money or a store of value across literally all cultures and political systems. It has survived thousands of failed governments, collapsed empires, worthless currencies. So what does that incredible historical track record tell you about the inherent risk involved in trusting only the currencies managed by modern governments today? Something to think about.
Thank you for joining this deep dive. Keep practicing your English, and we'll see you next time on your Daily English Dose.